Good afternoon, ladies and gentlemen. Welcome to the MERCIA Asset Management PLC preliminary results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and if you could give that your kind attention, I'm sure the company will be most appreciative. I'd now like to hand over to CEO Mark Payton. Good afternoon.
Thank you, and welcome everybody to MERCIA's preliminary results for financial year 2023. Just as introductions, my name's Mark Payton, Chief Executive for MERCIA and co-founder of MERCIA. Strong focus on the life science portfolio. I manage a number of our direct investments within the life sciences and something like 20 years of investing across the tech space, in particular in life sciences.
Hello, good afternoon, everybody. I'm Martin Glanfield, MERCIA's CFO. I joined MERCIA as employee number 7 in October 2014 to IPO the business with Mark. And my background is mainly as a CFO of publicly listed and privately backed technology-enabled businesses in the UK and the US.
Good afternoon, everyone. Julian Viggers, Chief Investment Officer. I've been with MERCIA since it acquired Enterprise Ventures back in 2016, and actually being a fund manager across various venture funds managed by Enterprise Ventures, latterly MERCIA, the last 20 years. The first one of those, way back in 2004, contained Blue Prism, where we were the first investors, investing £1 million, and then ultimately realising £95 million through selling down on the market. Thanks, Mark.
Thank you, Julian. And just to the left here, before we go in, you can see the map of the UK, and the white dots represent the 11 offices that we have across the UK in key cities, which we think are critical in terms of deal origination and in terms of capital deployment, from from London, from Bristol, through Birmingham, Manchester, Leeds, Newcastle, etc. And that's really part of our model here, is one of national deployment and actually being in the regions and the regional cities to see deals that others do not see. Just by way of highlights, both on operating basis and within the financials, 1.4 billion is the assets under management we have today, and that's grown from approximately 959 million. Importantly, 165 million across the group, that's our funds and balance sheet, has been deployed in terms of capital deployed. And again, that's up from 124 million the year before. We've seen cash realizations across the group, that's funds and balance sheet, continue with 71 million in cash returns. And I think critically here, strong cash, unrestricted cash across the group of 378 million. That's the funds and the balance sheet. So over a quarter of our assets under management are in unrestricted cash. Looking to the financials, group revenue has grown to 25.9 million with an adjusted operating profit at 7.6 million. As I said, strong cash, and this is on the balance sheet, which is debt-free, of 37.8 million. And net asset value per share, NAV per share, is static at 45.4 pence, which we think is a strong reflection of the portfolio and its performance in this challenging economic environment. And importantly, because of the profitable group that we have, the cash generative fund management operation, which means we do not see erosion of NAV through the cost of the operation. As we continue to grow the business and its momentum, it's pleasing to note the 0.53 pence proposed final dividend, and that takes the full year dividend to 0.86 pence per share, which itself is up from 0.8. The investment model, in many respects for MERCIA is simple, in as far as we combine a scalable, highly scalable fund management operation with a direct investment, a complementary direct investment capacity, which we term proprietary capital. So our fund management operation is highly scalable, which is evident from these results and previous results. We also have the opportunity within these discrete assets we manage for adjacent asset class expansion, and we'll talk a little bit to that in a moment. There's a nicely recurring and predictable fee income from the fund management operation, which is profitable and importantly cash generative. And then across to the right side of this schematic is our proprietary capital, which is focused very clearly into three areas. The first is to selectively look to, and we have something like 300 venture businesses within this portfolio, to look to those businesses as they develop and co-invest with the funds as they come onto our balance sheet. And we've added 3 new investments this year. The second element is to be an investor in a number of those funds, a limited partner, an LP, again on a selective basis. And the final part of the use of this capital, our proprietary capital, is to look at selective opportunities to acquire capabilities or assets under management through our own cash resources. And that's really important. We're not going back out to the city to raise money. We have cash and cash generation to do that ourselves. And FDC, the recent acquisition at FDC, is a good example of that. Bring those 2 units of MERCIA together, aligned and pointing towards the regions across the UK. You have a fully aligned group focused on capital growth and yield. I think it's important to just reflect on the market that MERCIA focuses on in the first place. And probably a way of doing that best is to look at the pools of capital we manage. So those are individuals, retail investors who are looking for tax efficient products such as VCT and EIS, public sector, and here specifically British Business Bank, and institutional capital, typically pension funds and regional pension funds within our private equity and our debt and property group. So at retail, we are addressing approximately 2.5% of the total addressable market of 19.5 billion. As one of the top performers in terms of VCT and EIS, we expect to grow that market share. And as I alluded to before about adjacent asset classes, we see BPR and IHT as a potential adjacent asset class to what we're already doing and leveraging that as we look to further growth in the near to medium term. In terms of public sector, British Business Bank, there's approximately 920 million available in regional venture and debt funds, and we manage about 22% of those. A number of you will be aware of the next generation of regional funds that are coming out now and will be awarded in the next 6 to 12 months. That's up from 920 million to 1.6 billion, and we will be aggressively bidding for those too. And then finally, the pool of capital, institutional capital, is split across our private equity group and across our debt and property group, which were acquired through the FDC recent acquisition. Again, strong regional presence, Northwest with the PE team and West Midlands with the property and debt team. There is ample opportunity to expand both of those, not just across the regions, but nationally. So tremendous opportunity to grow the third-party funds under management of the group as we look forward to the next 6, 12, 18 months of growth. MERCIA 2020 was the strategic vision we set out 2 years ago, where we anticipated growing assets under management by 20% per annum over 3 years, averaged over those 3 years, or perhaps better looking at it as 600 million in total over those 3 years. And we find ourselves today at 1.4 billion, up from 959 million. And that 1.6 billion in terms of achievement and beating is eminently achievable. Then the second part of that 20 is 20 million in profit before tax in PBIT per annum over 3 years and averaged. Another way of looking at that is 60 million over those 3 years. We're at 30 million at this 2-year point and remain focused on achieving that 60 million goal by the end of this financial year we've now entered. Those two coupled together is when we brought forward our progressive dividend policy, starting at 0.8 pence per share, this year growing that to 0.86 pence per share and expecting that dividend to grow again into this next financial year. Martin.
Thank you, Mark. I'm pleased to confirm that assets under management grew by approximately 50% to just over 1.4 billion during the last financial year, and there were no redemptions. From a starting position of 959 million on the 1st of April, we added 415 million with the acquisition of FDC and a further 134 million from organic fundraisers and additional allocations from existing investors, which you can see on the right-hand side of this slide. We experienced a relatively small fair value reduction of 29 million across all of our asset classes and distributed 42 million to our fund investors, together with our PLC and VCT shareholders via dividends. All in all, it has been a very positive year for our AUM growth, despite the market backdrop. This slide provides more granularity on the makeup of our AUM by asset class, investor type, and funds type. Combined, these typically long-dated or evergreen funds are generating a blended fee margin of circa 2%, and we're able to invest across the UK under the many different fund mandates that we manage. As you can see, we are diversified by investor type and asset class, and 80% of our revenue is contracted and recurring, which is of great comfort to us during these unpredictable times. The remaining 20% comes as a direct result of our investing deployment, which we are intending to increase in the current financial year, and we believe that there is much more to come in the foreseeable future. This slide is our profit and loss account under International Financial Reporting Standards. And here you can see that our top line revenues grew by a headline by 12% during the year, with the underlying growth being 11%. Our underlying increase in administrative expenses, which includes salaries, was 10%. So we, even in a challenging year, we have still managed to increase our margin across the group. We've also managed to remain profitable during a period when it's been very difficult for others in our sector to do so. And therefore, our profit after tax for the year overall is a very good result, we think, at 2.8 million. And in a moment, Julian will talk to the movements in the direct investment portfolio. Our balance sheet remains extremely strong, and we've managed to nudge up our net assets from 201 million last year to 203 million this year. And you can see there our strong cash position, which a year ago we were earning next to nothing in terms of bank interest. But now I'm pleased to say that we are now earning circa 4% on our cash balances, which will be a significant contribution to our profitability in the current financial year. We're very focused on generating cash from our trading activities and not just paper profits. And once again, you can see here that we've generated cash from our operating activities during the year. And the cash flow statement also shows the major movements of cash flows during the year, including direct investment activity, the acquisition of FDC, and the dividends that we've paid to our shareholders. And finally, from me, this slide shows our share register, which for a small AIM-quoted company is an outstanding share register. And we're also very appreciative of the 10% of our share register, which is held by individual investors. Thank you.
Okay, thanks, Martin. Hello, everyone. So following on from Martin's AUM momentum slide, this one on the right-hand side shows the split of 1.4 billion across our areas of activity, but also the significant liquidity that Mark mentioned there, 378 million. On the left-hand side, you can now see that we have a complete suite of investment products. We can invest from as little as 250k all the way up to 10 million as the business scales. So for the venture deals, early stage venture team can invest typically 500,000 to 5 million in follow-ons. Scale up team, which is largely our VCTs, from 3 million to 10 million. Our PE function, 2 to 5 million equity checks. And our debt side, so the smaller sub 1 million debt rounds go through our regional teams, and now with 10 million of up to 10 million with FDC's national debt products. And so you can see where FDC fits, enabling those larger debt checks for us. So as always, some stats to show the scale and growth of MERCIA. So deal origination always critical to us. We see a constant 200 or so opportunities per month that we are generating. Last year, we invested a record 165 million pounds into 176 businesses, and the additional 40 million between this year and last year was deployed mainly across our national venture and debt side. And again, our debt team was especially busy with 20 or so more businesses lent to across the regions in this year. The last line in this chart shows our direct activity, and that shows that we were very similar in many ways to FY22, but with 3 new deals added to the portfolio, and those were Nova Pangea, Axis, Spine, and Unify. Okay, so this is the year in numbers. It's a little bit more complex than previous years, so I'll go through it in a little bit more detail. So on the left-hand side, the brought forward value 120 million, to which we added a further 21 million. Again, within that is 6 million for those new deals. 4 million of cash realised. The next column is the realised gains and losses. We'll come back to that in a minute. Fair value movements across the year, stable, largely flat, 1.2 million, and that leaves us with the portfolio value of 137 million that Martin was talking about. So a little bit greater detail on the realisations. So starting off with in Technica Holdings on the left-hand side, the bottom row. So the brought forward value of that business was 14.4 million. And if you recall, in April, we split that out into Netasia and Technica. In our interims, we appended a value of 12.2 to Netasia, 2.2 to Intechnica. Then in February of this year, we sold Intechnica for 4 million. That's the number there. And that generates the 1.8 million of gain you see in the second to last row. Sense Biodetection was also an asset that we had really high hopes for. Unfortunately, we sold that pre-Christmas in an accelerated process, advised by Goldman Sachs, to a business called Sherlock Biosciences in a share-for-share deal. That unfortunately generated a 2.6 million loss. You can see that number again towards the bottom of that chart. Onto the fair value movements. So we were 5.6 million at the first half. Since fallen back to 1.2 overall, but that is stable, and we think a good performance in this current market. Now, first of all, I'll explain the second half. Largely, the 4.6 million number in there was the result of us writing down Edge Case Games and W2 in the second half, and they now fall out of our top 20. Now, Netasia, also, we've written down by 3.5 million. You can't see that number actually. It's you get to it by summing the 8.7 Netasia fair value movement and the 12.2 number against Intechnica in that column. And again, that's really as a result of software multiples declining across the board, not balanced in this particular case by growth within the business. Now, that was balanced. And I think in a very positive way. So we had 5 positive fair value movements. The biggest 2 was across our mobile games businesses, Invincibles and VertTrade. And those really are simply a function of the growth in revenues on those businesses. Alongside those, Warwick and IOTO made significant tech and commercial progress, accompanied by new third-party funding rounds. So in overall, I think despite tough conditions, the vast majority of our portfolio have made real progress in the year. Thanks, Mark. Okay, so I'm just going to explain a little bit more about our valuation methodology. Clearly, first and foremost, it follows the IPEV guidelines, but importantly, we spend an awful lot of time carefully considering each asset. We do think that the price that someone else puts on these assets to be the best approximation to value. Clearly, we then calibrate. What that really means is sense check those values based on the passage of time, but also against actual progress, results, milestones, and of course, market multiples. And that green piece of the pie, sorry, blue turquoise, accounts for 58% of our 137 million. Now, the bulk of the remainder of the portfolio is valued as a fundamental assessment of enterprise value by us or indeed by third parties. And again, that uses market multiples and comparables versus trading. Now, we only have one listed asset, which is My Health Check. That's valued clearly at bid price. And the green in there is cost, and that represents a couple of the new assets that we've most recently put onto our balance sheet. Thanks, Mark. So again, I guess, first of all, overall neutral in terms of fair value movements in a tough year, but a lot of strong positives. So I guess the themes are that the manufacturing assets, kind of deeper tech assets and medical assets have made some real progress, as has our games businesses, and that's been balanced really by the software businesses within the portfolio that have been under some pressure. So I'm just going to call out a couple of these. So nDreams is our VR developer, and again that is going very well. Lots of momentum in this business now. So 6 games to be launched across the course of the next 12 months. In fact, one was released on PSVR 2 yesterday. $12 million of new deals signed since April. We're now up to 230 people across 4 studios, and there's a lot of positive momentum in the market as well, as PlayStation VR 2 launched recently. We're going to see a new Quest headset in the back of this year, 2023. So again, a lot of positive momentum there. At Netacea, I'm just going to call out again, just very briefly, cybersecurity, bot and API management, moving into a really interesting area called defensive AI as well, we think. Spun out, as I've said, of Intechnica. We've seen a little lowering of growth, particularly in the last 6 months from the US. But actually, recently, we've seen some ARR progress in the last quarter and some interesting partnerships developing. Thanks, Mark. Okay, so in terms of this slide, just to call out VertTrade and Invincibles. So both mobile games developers, both own their own intellectual property, so they have created their own games. In the case of VertTrade, that is Cards, the Universe, and Everything. And in the case of Invincibles, it's a franchise now, an annual franchise called Soccer Manager. Importantly, we have 2 new games due out from Invincibles over the course of the next 12 months, and a new look and feel for Soccer Manager 24, which will be out in September. I just want to also call out Warwick. So Warwick is our flat speaker, very lightweight, high quality speaker system. And we announced the very first OEM deal very recently, and that's a result of 3 or 4 years of efforts from the business. So the speaker system has been nominated on the highest spec model of this particular OEM on their 2025 car, and we are expecting revenues to come through during 2024. And the momentum doesn't stop there, actually, because we have 3 other POC deals in operation with 3 different OEMs, which hopefully will follow that on Warwick. Thanks, Mark. Okay, so this slide simply shows that our balance sheet is performing well, tracking at 13% IRR. Also shows our record of realising on average 50% above carrying value at exit. What does that mean? Does it mean we're conservative in terms of our valuations? Does it mean that some of these assets are hard to value? I think it certainly means that certainly some of our assets are attractive to buyers who are willing to pay strategic prices. And those are perhaps above the the ones that you would normally see by applying the valuation metrics. So overall, I'm pleased with progress in a tough environment, and it shows the resilience of our portfolio and the fact that it is well diversified across sectors. Mark.
Thanks, Julian. So the last three slides, and just before I go into the last three slides, can I remind people we will be delighted to take any questions that you may have, and we will look to answer all of those questions as they come through. As mentioned, you can see our reach across the UK through the various offices we have, and we very much see ourselves as a leading domestic UK impact investor. And what I mean by impact investor is that our institutional capital that we manage is actually via their impact allocations as they look to support the regions and regional businesses. We have tax efficient capital, EIS and VCT, which is created by the government to get capital into equity gap financing. And of course, the public sector, British Business Bank, is creating and managing these funds, again, to address equity gaps. And based on the fact that we find ourselves in the top quartile, often the top 10% of investors out there in these categories, we see ourselves as a profitable commercial impact investor. And the pace of growth of MERCIA can be seen in that bottom right corner. Capital deployed over the 3 years has grown from 94 million to 124 million to 165 million this year. So up over 30% each year. And we expect that to continue. And the reason why that's important is that, as Martin has said, over 80% of our income that comes is deferred, and we have sight on that coming through our management of our funds. The remaining 20% relates to our investment activities, arrangement fees, deployment fees, etc. So as capital increases in deployment, so does the fee income on that basis. And just in terms of the pace of our growth, you can see the size of the portfolio now. We have 140 people at MERCIA, a lion's share of those dedicated to supporting, to finding, unearthing these deals and taking them forwards. The majority of those deals split between ventures and debt. And we're also an active investor in university spin-outs. Over our time, over our journey since foundation, we backed something like 74 university spin-outs. Of that number, the 567 there in total portfolio, approximately 5% of those are university spin-outs. So they're very important to us, university spin-outs, but actually a minority of the activity that we take part in. And our focus actually for this year, I'm hoping, is evident from the presentation given from Julian, Martin and I, specifically relating to the third-party funds under management and our balance sheet. In terms of the third-party funds, we see a tremendous amount of organic expansion across all pools of capital we manage, be it retail, be it public sector, or be it institutional. And we expect that growth to come through in the next 6, 12, 18 months. With that growth goes that continuation of our progressive dividend policy, the focus on what we see as a strong, maturing direct investment portfolio is where our cash realizations, of course, come from, making that evergreen and continuing its evergreen journey. Our own cash resources can then be used selectively if we think it's right for acquisition of capabilities or further assets under management, but that would be within our own free cash resources. We wouldn't be raising money for that. So why hold a share in MERCIA? Why invest in MERCIA? All three of us are material investors in MERCIA. Across the group, employees and the board, we own 17% of MERCIA. So we see full alignment to the other owners of MERCIA. But in short, you can see the long-term revenue visibility, the sustainable, profitable growth of the group, and importantly, this evergreen balance sheet. And what we haven't discussed today is the modest capital outlays that go into these businesses on our direct investment portfolio. And that's really important in terms of syndication risk, etc. If a chill wind comes through and others stop investing, all of our direct investments, we hold a direct position in as well as a funds position in. We can support a majority of our direct investments on the balance sheet going forwards. Other reasons for buying a share in MERCIA, for holding a share in MERCIA, 100% of our third-party funds, and that's over 1.2 billion of the 1.4 billion we have under management, are in closed-end funds. They are not subject to redemptions and returns of capital in that respect. Across that group, across the fund management activity, we have a blended 2% fee margin approximately. I've discussed the organic funds expansion opportunity. I think also critically, and I'm hoping you picked that up from Julian talking about the likes of Endreams, Warwick Acoustics, etc., is that we see strong growth in the direct investments. And therefore, when you see such a strong discount on a NAV per share basis to the direct investments, we think there's true value there. In terms of risk profile of the group, 378 million in free cash across the group, 38 million of which on the balance sheet in a debt-free basis, is a strong position for us to face forwards for both building positions within existing portfolio as well as adding to new businesses going forwards. We see our direct investment approach as strong, the portfolio as resilient, and importantly, as we go into the new year, into this new financial year, momentum continues. 23 million already of fund inflows. We're about to close another EIS fund. We've announced the fundraising within our VCT fund. We have top-ups from the BBB regional funds that we already manage, and that discounts all the new mandates that we'll be going after over the next 12 to 18 months. So thank you all for your attention, and for those that are shareholders for your continued support, and we'll be delighted to take any questions that you may have.
That's great. Mark, Martin, Julian, thank you so much for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated on the right-hand corner of your screen. While the company take a few moments to review those questions submitted already, I'd just like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Mark, if I could please invite you to open up the Q&A tab. You'll see you've had a number of questions from investors throughout your presentation, so thank you to everybody for your engagement. If I may, Mark, just ask you to read out the questions and then give a response where it's appropriate to do so, and I'll pick up from you at the end.
Perfect. Thank you very much, Mark. Just noting them down. So what I've done, as for those who've joined us before, is I've tried to theme them, and the three of us will sort of try and answer them. I've themed all questions, and we've had a number of questions ahead of this as well. So I'll start off actually on the corporate. I've put a section on corporate in this regard. And Martin, one question is, when will the dividend be paid?
Yes, I can answer that question. So on the very front page of our RNS this morning, down at the bottom of the first page, you'll see that if the proposed dividend is approved by shareholders at the company's annual general meeting on the 21st of September, then it will be paid on the 27th of October to shareholders on the register at close of business on the 29th of September.
Brilliant. Thank you very much. And another question relates to the discount on our net asset value per share. And have we considered a share buyback to try and narrow that discount?
Yes, we have. And we never rule anything out. And if I may, I'd like to just come at this answer from a number of angles. First of all, we fully understand the concept and the positive impact on EPS, NAV per share and dividend per share. And I'll give you, if I may, a worked example. So in our case, if we were to say use 10 million pounds of our current cash at a share price of say 25 pence to buy back MERCIA shares, that would enable us to buy back 40 million MERCIA shares out of our 446 million shares. But that would represent 26% of our cash gone from our balance sheet against an uncertain economic backdrop, whilst the increase in NAV per share would only be 2 pence, which is 4%. And the increase in dividend per share would be 0.8 pence. By comparison, our balance sheet portfolio has a current IRR of 13%, and we have made 3 successful earnings-enhancing acquisitions from our liquidity, our own liquidity, largely. So in our current view, the risks associated with 26% of our cash having gone from our balance sheet, that risk is too great for us to take, when what we need also to do is not just pass the going concern test with our auditors every year, but also we need to ensure that we retain enough cash runway to continue to support our direct investments. And typically, we like to run with 2 years of investment runway. I'd like, if I may, also to give a practical example of why we don't believe that share buybacks are in the best interests of MERCIA shareholders. And some of you may be aware that over the last 12 months or so, IP Group have spent £35 million of their shareholders' money on a share buyback program. Despite that, in the last 12 months, IP Group's share price is down 20%, and they now have a loan facility in place upon which they're paying interest effectively on the 35 million that has gone from their balance sheet. So not only do we not think that at the moment share buybacks work in practice, we think that that £10 that I've just given you, £10 million I've just given an example, that we do have better uses for that money on behalf of our shareholders. And finally, we do believe in returns to shareholders, and that is why we enacted our progressive dividend policy a couple of years ago. So we are making returns to shareholders every year, but just not in the form of a share buyback.
Great. Thank you very much, Martin. There's another question on capital allocation priorities. I'll just pick this up. The particular individual has asked, are your priorities in order of preference existing investments, new investments, dividends, buybacks? Well, I hope you heard Martin's point on buybacks, so we would drop that one off the scale. Existing investments, absolutely, at the number one priority. New investments, of course, we can turn on or off, and that's the flexible element of it. And we have a commitment with our profitable fund management group to a progressive dividend. So probably would switch that to existing investments, the progressive dividend, and new investments. And as Martin's quite eloquently pointed out, buybacks we do not believe is the right thing for the group. Another question has asked, why move the AGM from Henley and Arden to London?
Yes, I'm happy to answer that question. So in our very early days, we did start having our AGM in London, and then we moved it up to Henley. But I think we believe that it's now time to perhaps move the AGM around the country, because obviously our shareholders are all around the country, particularly our individual shareholders. And so as part of our sort of engagement program with our shareholders, and we have had requests from a number of individual shareholders who would like us to return to London. And bearing in mind most of our institutional shareholders are London based, we've decided to come back to London for this year's AGM. And in terms of the venue, it'll be at the lawyers Reed Smith, and the details of the venue are at the back of the RNS, and of course will be published in the notice of AGM, which is in the back of the annual report, which will be posted to shareholders and on our website on the 28th of July.
Thank you, Martin. Another point here asked whether Ray Chamberlain is included in the 17% in terms of ownership against employees and the board. And yes, he is. So Ray is a co-founder with me, actually, within MERCIA. Another question says, or it's really a statement, says the PBIT of 60 million looks a stretch when you're at 30 million. We've always said that it's lumpy because it's our direct investments. We're hoping you've seen that actually our direct investments are in good shape, and we expect continued performance to come through that. So we continue to be focused on achieving that 60 million. Another question asked, why has the share price performance been so poor over the past few years? I mean, I'm sure every chief exec that everybody talks to says the share price is too low, but we had a number of unfortunate exposures, if you like. We had a high profile shareholder, for instance, that was a forced seller that hurt our share price, and a number of other incidents over the time. All we can do as the three of us is focus on deploying shareholders' funds into funds and into investments that we think will provide a strong return. Our hope that the share price will catch up with us and do events like this to communicate the positive progress that we are doing. Just moving on to direct investments. Julian, one question asks, are you planning any direct investment exits?
I guess the simple answer, given that we have stated that we have evergreen the balance sheet, clearly at some point over the course of the next 18 months, we will be selling one or more of our assets. I can't tell you which one it's going to be, but what I can say is that many of our top assets will be passing through inflection points over the course of that period, be it clinical trials readouts, be it revenue increases, partnerships, OEM deals, new games released, or whatever it may be. And I will say that we do get approaches for our assets on a regular basis. So yes, we will have the opportunity, I'm sure, of selling any one of our top 10, or even other assets. And if that opportunity is right, then we will certainly take it.
Thank you. And we've had the favourite child question. So can you pick your 3 best direct investments?
I'm afraid I'm never going to do that. The reason that these assets are on the portfolio is because they are the ones that we have, I guess, selected from the many hundreds that were in our funds. So you can see from the progress that I've highlighted that certain assets are doing exceptionally well. Yeah.
Wonderful, thank you. There's a question about write-downs and whether we've taken any or not, but you've walked through the fair value movement, so I think that's been addressed. Martin, there's another question that we had before the meeting, yes, which was about whether we voted or not at the My Health Check AGM.
Yes, there's a pre-submitted question actually, which is a two-part question, and the first question is did we vote our shares in My Health Check at their AGM on the 11th of May? And then the second part of that question is that the questioner did actually contact us before then to ask us that question, and unfortunately did not receive a reply from us. So first of all, apologies from all of us for that. What happens, just so you know, what happens is that when questions come through our website at info@MERCIA, they are normally the person who receives the invoices, the emails, then tries to find the right person with MERCIA to answer the question. And in this case, normally those emails probably come to me. Unfortunately, on this occasion, it didn't, and so we didn't reply. So apologies for that. But what I can say is yes, that our balance sheet stake in My Health Check did vote in favour of all the resolutions at the recent AGM.
So Julian, entry valuations in the current climate, are you seeing any change to those?
I think the fundamental question was the expectations of vendors. In terms of the entry valuations, and yes, I think that vendors do have some higher expectations, particularly I guess where the market is very calibrated in terms of the if we look at our software sector, for example, you can see valuation differences coming in depending on the growth or the stage that you've achieved. So I think some founders or vendors do have higher expectations than the market is at. And yes, we are seeing an increase in opportunities. We are in a good place in terms of, we as I've said, we have significant capital to deploy. So, we can take advantage of those opportunities coming through the door.
And just following on from that, a further question was about the direct investments and the reviews of them. So how many direct investments do you review a year, audited, etc.?
All of them.
So all direct investments, to answer that, are reviewed internally. And actually, we have a 6 monthly, our auditors look at these on a 6 monthly basis, which I think is really important to note. So it's not just an annual audited review, but it's reviewed every 6 months. Coupled with that, our third-party funds are also audited by our auditors as well. So there's a look at the valuations within the funds and then a consistency and read through across to the balance sheet. And I think that's a really important note to take. Julian and his team review these regularly. Actually, we have very regular reviews of their progress and the things that we should be doing to change their trajectory, etc. There was another question that was asked about policy changes, UK policy changes, and whether this sort of throws up new fund opportunities for us. Well, I mentioned the British Business Bank's second generation of funds. That was a policy change. It was originally European capital. That's now national capital. Those funds are larger, so can invest more, and they're bigger checks as well. So more money in the funds and an ability to write larger checks from those funds. Those policy changes are frequently directed towards regional deployment. And as one of the most active regional investors, of course, we will look to those opportunities as they come through to us. And I think the last question actually is, what is the group's stance on ESG investing? Just stepping back from that, our stance on ESG in principle is high, is very important to us. I'm part of a responsible investment team. I report into Alice Greaves, who heads up the responsible investment team. And all elements of ESG percolate through our operation, from sourcing to employing to growing these businesses. On an employment basis, we look very carefully at diversity and inclusion as we look to grow the business. So ESG is important in our operation and is included within every single investment committee paper that we write as well. So it's at the heart of our operation.
That's great.
Sorry, Mark. One more question and then we're done. It's just popped up. How do you sieve new direct investments, and how many proposals do you process a year, Julian?
Yeah, so the within our funds we have circa 250 positions. So obviously as a chairman of our investment committees, I have sight of all those that come through. We have individuals within our team that I guess drill down against what we see as the most promising assets within our funds, and perhaps we would consider 25 or 30 of those in a year. But again, we will be, just because we don't invest in one particular year doesn't mean to say we're not going to do it at some point in time, because it's got to be for us the right time, and that is typically when we have a team that is right, or at least right for the stage that business is at. It has proven whichever particular business model it is looking at, and has various different be it either revenue markers or partnership markers or technical markers. And I guess that the overall sieve is one of us trying to keep a rounded balance sheet portfolio by sector and stage. So it's kind of multifaceted really in terms of the approach here. Hopefully I've answered that one for you.
That's great. Thank you, Mark, Martin, Julian. Thank you very much indeed for taking your time with all those questions. And thank you once again to everybody for your questions and your engagement this afternoon. Mark, I know investor feedback will be particularly important to you and to the rest of the team, and I'll shortly redirect those on the call to give you their feedback. But I wonder, before doing so, if I may just ask you for a few closing comments.
Thank you, Mark. Well, firstly, I'd just like to thank all of those that have attended today. Investor Meet platform, which is just fantastic, actually. So I think we really enjoy engagement with our individual investors into the group, and to thank our employees, our investors in our funds as well. I mean, we've created now a sustainable, profitable specialist asset manager that is cash generative, serving a progressive dividend policy that we expect to fulfill, as well as strong growth to come from our direct investments. And I think really critically over this coming period of uncertainty, strong prospects of further third-party funds under management organic growth. We're optimistic for the period coming forwards, and as I said, we'd like to thank everybody who's supported us with that support to date. Thank you very much, all of you, for your attention.
Mark, thank you very much indeed. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of MERCIA Asset Management PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.